Welcome back to this channel. This is Unfiltered Forex with me, Clement, and in this video, we'll be talking about liabilities. Second part of talking about the balance sheet. So, in this video, we'll be talking about liabilities. So, let's go over to the balance sheet. Here, you can see this is the balance sheet of Tesla, and we talked about the assets in the last video, and now we're going to talk about liabilities. There's also shareholders' equity, but that's also another big part on its own. So I will avoid talking about this on this video. I'll prepare a separate, more dedicated video going into details about shareholders' equity, because in this context, talking about publicly listed companies and trying to analyze whether their stock is at a good position to buy or sell, the shareholders' equity part of the balance sheet is going to need a whole other video on its own. All right. So liabilities. Just like in the assets part, there are current and non-current liabilities. This part is the current liabilities. So let's go over them. Short-term debt and current portion long-term debt. Okay, so as you can see, there are debts that companies do have in order to finance the operation. Companies do take loans to finance or even to expand the operations. So some debts are short-term. These are debts that are supposed to be fully paid within the year, and this current portion long-term debt, these are debts that out of the whole repayment period, there is a payment that's supposed to be made within the coming financial year, a portion of the long-term debt that's supposed to be paid within the coming financial year. So that's why you can see there is short-term debt and current portion of long-term debt. Short-term debt, that's the amount. Long-term debt, that's the amount. Trying to determine whether this is healthy or unhealthy, don't worry, we'll come to that when we're looking at the ratios. For now, it's just important for you to see and understand what this means. Coming to accounts payables, this is the opposite of accounts receivables. I'm sure you remember we did discuss this a bit when I was talking about inventories. So this is the opposite of accounts receivable. This is vendors or suppliers that have provided goods or services to the company but have not yet been paid. Okay, let me switch to a more to another balance sheet here. Current liabilities. Yeah, there's a definition here. Accounts payable, short-term debt and liability where a business owes money to its vendors and suppliers that have provided business with goods or services on credit. Remember, this is the opposite of accounts receivables. Account receivables was goods given or services provided on credit. Okay, so accounts payable, this is goods that have been provided to the business or received a service on credit. This is like a short-term interest-free credit line for the company, because this means the company is receiving some goods or some services without paying for them immediately. Okay, so that's like a short-term loan. Now allow me to go back to the inventory turnover ratio. The inventory turnover ratio. So the inventory turnover ratio, I'm sure you remember, this is how fast inventories are converted to cash. Okay, so this means like in about 60 days, inventory is converted to cash. Okay, because cost of goods sold, average inventory 5.86 times in a year, divide that by 365 days. It takes an average of 60 days for this business to convert inventories to cash. Okay, so this 60 days means that coming back here to accounts payable, that 60 days means that this accounts payable are usually cleared within around 60 days. That's for that particular business. Okay, so trying to determine whether this number is good or bad for them, for the business, you'll have to go to the annual report and see on the notes section, like what's the average duration that it takes for them to clear out their accounts payable. And from here, from the inventory turnover ratio, it takes about 60 days, okay, on this business. So the inventory turnover ratio, like we said, there are industry benchmarks. There is no benchmark for all businesses, but there is usually a benchmark for an industry, like how fast are goods supposed to move within this industry. Okay, remember this was around Tesla. This was talking about Tesla, and if Tesla can sell their cars in 60 days, like clear out the inventory, not just cars, but even the parts that they do sell. If they can clear the inventory in 60 days, that means they have interest-free credit line provided by their suppliers of around 60 days, which is not so bad. 60 is only 2 months. Yeah. But if you're looking at this from a different company, like companies that retail companies, okay, like this big retail chains like Walmart and even Amazon, those companies, if their products are staying on the shelves for too long, if the inventory is staying on the shelves for too long, that's a red flag, okay? But again, you need to compare with the industry average to see if the number is good or bad for business. Okay, moving on, there are accrued expenses. So, what are accrued expenses? This one is blank. Expenses that are recognized on the books before it has been paid. The expense is recorded in the accounting period in which it is incurred. In a business, typically there are services you use. Okay, this primarily includes utilities and salaries that have already happened. Like utility bills, we're talking about electricity and water that you have already used, but you have not yet paid for, including employee salaries, employees that have worked in this accounting period but have not yet been paid. Okay, again, rent, bonuses, commission, income taxes payable. This is essentially expenses that services or goods, not goods or services, but rather just it's usually mostly services that you have received and even goods that you have received, but you have not yet received an invoice. All right. Let's say you are on a subscription, uh, like how electricity bills are usually paid at the end of every month. All right. If it's a postpaid service, even water bills, most of the bills, essentially, even employee salaries, are usually paid at the end of the month. So, assuming for a factory or a big companies on a big company basis, they usually pay on a quarterly basis, some pay on a yearly basis. Like, for example, let's check a balance sheet that has actual numbers here. This is the balance sheet of Tesla, and as you can see here, this has been specified. Now, they are not all combined into accrued expenses, but rather there's an accrued payroll here. Okay, so this can include employees that have not yet been paid for this accounting year. Okay, because this is 2023. So this means by the end of 2023, there were employees who had worked but they had not yet been paid. Why? Not because the company doesn't have money, but it's not yet time to pay them. Okay, they have worked, but it's not yet time to pay them, so they're going to be paid in the next accounting period when it's time for them to be paid. Okay, but the same with utilities. You can see utilities here, but yeah, it's usually here. Utilities that the company has used, but they have not yet paid for. Not yet paid for. Why? Because they have not yet received the bill. It's like when you go to a hotel and you eat, and you get the bill afterwards. So yeah, in the process of spending this um, utilities, an accounting period ends, and the cost, or rather the expected expense, is supposed to be paid in the next year. So that comes as a liability to the company and it's recorded as an accrued expense. Okay, let's go back to here. Short term borrowings. This is the same as like we talked about short term debt, current portion of long term debt, same story, current portion of lease obligations, same story with current portion of long term debt. Current income taxes payable. Again, it's very similar and almost the same to the accrued expenses because you pay taxes for a specific accounting period. So if the year is ending and you have not yet paid your taxes for this year because it's not yet time to file returns, so you're going to pay them next year. And yeah, that's what it means. Their income tax is payable. If we go back to here, Yeah, you can see there's a number on this balance sheet, income tax payable. This is a liability because this is money that they are supposed to pay out in the coming financial year. Remember, current liabilities is debt obligations and even just financial obligations that are due within the next 12 months. Okay. Moving on, there is unearned revenue current. All right. Unearned revenue is money received by the company for a service or product that has yet to be provided or delivered. Now, remember, let me just give you an example so it can be easier to understand what unearned revenue is. This can also be called deferred revenue. Okay. This is usually subscriptions or money paid in advance. This is just money paid in advance. Okay. It can be warranties and insurance premium. And yeah, this is generally advance payments that have been made to the company before a service is rendered. For example, we are talking about Apple here. This is the Apple balance sheet. And you remember there was they launched the Vision Pro, right? So, assuming the Vision Pro was supposed to be launched in the coming year, this is this is this is the accounting period for 2023. Assuming the Vision Pro was meant to be launched in 2024, and there were people who had paid for it before the launch, which is quite normal. See, that money is going to be recorded here as unearned revenue because it's money that they have received, but they have not yet provided the goods to the customers. All right, that's why it's here an earned revenue current. It's usually subscriptions, but not subscriptions for the current accounting period, but rather subscriptions for future accounting periods. Okay, because at that time in that future, that's when it will be recorded as revenue, but currently it's recorded as an earned revenue, meaning it's a liability at that, meaning at that point in time in future, they will provide the service without being paid because the customer paid in advance, and that's the unearned revenue. It's a liability to the company. All right, so unearned revenue is also some sort of what do you call it, an interest free credit line for companies, for some companies, because if customers can pay in advance, it's good because now if you didn't have money, now you have some money on top of the money you already had to deliver the service or the goods. Okay. Yeah. So it's in some cases, some companies do depend on this. Yeah. Even insurance premiums. Yeah, I remember I did mention it among the examples. Yeah. Insurance premiums. Insurance companies, they do take money for future stuff. Like if something happens to you in the future, then that's when they're going to provide the service for money they received in advance. So yeah, an earned revenue is going to be there. Other current liabilities. All right. Before I go to other current liabilities, let's go back to this other balance sheet and check. hmm Is accrued payroll dividends payable. Yeah, some companies do pay out dividends, but as you can see here, this is just Tesla don't pay out dividends, but some companies do pay out dividends, and Apple does pay dividends, but it's not here because it's not a liability. Because and if they have already paid dividends for the current accounting period, then in the next accounting period, that dividend will be recorded in at that time. It's not going to be recorded here. Okay. Yeah, so that's it. Dividend payrolls, miscellaneous current liabilities, and yeah, there is also accrued interest on borrowings. Okay. Um, it's not here. Yeah, I couldn't find exactly a balance sheet that's there, but there you might find accrued expenses like accrued payroll, accrued interest on borrowings, and that's going to mean the same thing essentially, right? That it's the interest on the debts that they are supposed to pay in the coming financial year. Okay, that's a short-term liability, a current liability that they are supposed to clear out. Right. So moving on, you can see this is the total current liabilities of the company. And you can see the liabilities are very real. Okay, this is all these are expenses that the company needs to deal with in the coming financial year. Okay, moving on, now we are talking about the non-current liabilities. This is where loans, long-term loans, taxes, credits, very many, essentially mostly debt is usually under non-current liabilities. Okay, employee benefits, and the rainy day funds, funds for in case the business starts to experience challenges. Even some long-term investments that are not doing well. Remember, there are investments that are doing well and there are investments that are not doing well. Those become a liability. Okay, if you made a bad investment somewhere, that will have to be recorded as a liability, and it's a non-current liability since the loss isn't meant to be realized within the current or the coming financial year. Okay, long-term debt excluding capitalized leases, non-convertible debt, convertible debt, capital lease obligations. Essentially, yeah, there's no need to go too deep into this ones. All right, provisions for risks and charges. Okay, now this is where I was telling you the rainy day fund for the company. They do have provisions for if they expect something to go wrong, like not in the coming year, but rather in future years. Okay, so they have that provision. You see, this is $3.61 billion, and it's quite a lot. Yeah, it's a lot more than even these other ones. And yeah, so essentially, this is expense that they might incur, a liability or an expense that they might incur in a period of over not but not in the short term foreseeable future. All right. Yeah, there's also deferred taxes credits, deferred taxes debit. This month that they are supposed to receive, I think. Yeah. The same story with the deferred revenue. Um Other liabilities, deferred income. You can see deferred income here is what is being called deferred revenue, unearned revenue, right? It can be called an earned revenue, an earned income, or deferred revenue or deferred income because it's yeah, it's pushed forward to the following accounting year or the following. Yeah, so you can see here the deferred income is under non-current liabilities because this is now income that is expected to be realized in more than 1 year. For a company like this, now remember when we were talking about Apple, we're talking about product launches and money that had been paid before the product is launched. And usually the product is supposed to be launched within the year. Okay. So, but for some companies, like you can see Tesla here, deferred income can be recorded as a non-current liability because of contracts. All right. Let's say Tesla received a contract to supply their electric vehicles to a government agency for the year 2024, not 2024, 2025 and 2026, 2 years onwards. All right. So at that time, that means money has been paid to Tesla for delivery of goods, but the goods aren't to be delivered in the coming financial year. This is the column of 2023, all right? So if the goods are meant to be delivered in 2025 and they have already been paid for those goods, this comes as a liability, all right? Because, yeah, even by the time probably they are making and delivering those goods, the cost of inputs might have gone slightly higher or lower, depending on how the market goes, but usually higher. And yeah, deferred income is essentially recorded as a liability, and it's recorded as a non-current liability if the goods delivery is meant to come in on period of over a year later. All right. And essentially, that's it for the liabilities. Okay, you can see the total liabilities here, and we are done with that part. Okay, now what I'm going to look at is the ratios. All right, Like now, you can see here total liabilities, total assets. This is a ratio, and we're going to go over the ratios. Like these are what are called the KPIs, right? The KPIs that tell you how strong this company is, how strong their financials are, on top of the ones we already looked at, right? So let's go over to the whiteboard. I'm sure you remember in the previous video we talked about inventory turnover ratio and accounts receivable turnover ratio, and yeah, these are some of the ratios, liquidity ratios that determine how liquid a company is. Okay, so let's begin. Okay, quick ratios. You have the quick ratio and the current ratio. Let's start with the quick ratio. This is the current assets minus inventory divided by the current liabilities, right? Essentially, what this ratio is, it tells you how quickly a company is able to pay, or the company's capacity to pay its current liabilities without needing to sell inventory to obtain additional financing, right? Suppose business is bad and inventory isn't moving. This ratio measures how well can a company clear its liabilities using its current assets without selling any inventory, right? Without making any cash from the inventory. That's what this ratio is. And essentially, the benchmark is usually two and above. This one, there's a benchmark, all right? It's usually two and above. Two and above meaning the current assets should be double the current liabilities. Current assets minus inventory should be double the current liabilities, such that if inventory isn't moving, the company can pay off its all of its current liabilities and still have current assets left to move on with the business before the inventory is starts to move again. All right. And essentially, usually, this ratio is what tells you how well can a company do during a recession, during an economic recession. All right. Like, because during a recession, that's when consumer spending is usually quite low. And if consumer spending is low, that means inventory isn't moving. But remember, the liabilities are there and they are very real. People, the people you owe money will still come for their money regardless of how your inventory is doing. So you need to have enough current assets to clear out the current liabilities without involving the inventory. Okay, moving on. Current ratio. Current ratio is the current assets divided by current liabilities. Okay, what's the importance of the current ratio? Of course, this, by the way, the current ratio is inclusive of the inventory. Okay, the quick ratio is to determine how the business is stable in case inventory isn't moving as fast. All right, the current ratio measures how liquid the business is under normal business operations, which is usually the case, mostly normal. Okay, so the current ratio is the current assets divided by current liabilities. How liquid a company is able to meet its current liabilities. Just like in the quick ratio, the current ratio, you're also going to get a multiple and it should be 2, 3, and above. Okay, preferably a 5 and upwards. And of course, you need to compare with the industry benchmark because I'm sure you remember some companies do not have any inventories, meaning there are services that there are companies that provide services. So the inventory is blank. The quick ratio is often the same as the current ratio for some companies. Remember, we saw Meta, they have nothing on their inventories. Google, they also have nothing on their inventories. Other companies, even Microsoft do have some inventory because they do sell devices, but for them, it's more of a service kind of company. So yeah, most companies on their inventories, the quick ratio is usually the same as the current ratio. Service companies, that is. Okay. All right. So that's it. That's it on the liquidity ratios part. I'm sure you remember the other two ratios, the inventory turnover ratio and the accounts receivables turnover ratio. Those are also liquidity ratios to determine how liquid a company is. Okay, now we're moving on to other types of ratios which are called solvency ratios. Solvency ratios determine how solvent a company is. And yeah, solvency in the sense that how likely is a company to go bankrupt. Okay, liquidity ratios determine how a company is able to meet its short-term financial obligations, but solvency ratios determine how likely a company is to go bankrupt. And we'll start with the main one. It's total debt to total assets ratio. It can also be called debt to assets ratio. Debt to assets ratio. It's calculated by dividing the total liabilities with the total assets. And then you're going to find, of course, a number. Let's say a company has total liabilities amounting to $300 billion and total assets amounting to $600 billion. The ratio here is going to be 0.5, which is 50%. This 50% means that half of the company's assets are financed by the liabilities. Okay, that's what it means. 50% means half of the company's assets are financed by the liabilities. And if we go back to a balance sheet here, you can see there is a row here, total liabilities versus total assets, and it's recorded as a percentage, right? This is for Google, so it means on average, this is 30% of Google's assets are financed by liabilities. Okay, it's done by dividing total liabilities with the total assets. So this means 30% of the assets are financed by liabilities. Let's check another company. Yeah, this is Tesla, and you can see Tesla 40%. Currently, this is the current one, this is the previous ones. As companies grow, they do take on more debt because, yeah, debt can be cheaper to acquire depending on the current macroeconomic environment. For example, when interest rates are low, companies do take on more debt compared to when interest rates are high because of financing. If you can get cheap financing, even if it's a liability, as long as it's a cheap financing, it counts to boost your business. So this time, this 40% means 40% of the assets are financed by the liabilities, right? Okay, companies that are likely to go bankrupt, this number is going to be quite big. Like at this point here, they were struggling financially because almost all of their assets were being financed by liabilities. All right, so yeah, if this number is big, it's scary. A low number is good. All right, you don't want too much of your assets being funded by liabilities. That's what it means. All right, let's go back. It's a red flag if it's high. All right, it's a red flag if it's high. A low number is good. A low number, like we saw here, this is Google. A low number is good. Again, there is no benchmark for these numbers. It's usually specific to certain industries because an industry like a bank, which primarily relies on customer deposits, and customer deposits are mostly liabilities, it's going to have a different benchmark from an industry that delivers services, which services really don't. Almost everything is an asset in a services industry, very little liabilities. So the benchmark is going to be different across different industries. But usually, for a business dealing with goods and services, it's advisable this ratio be small. A high ratio means a company is not likely to survive a recession. All right, like during the current macroeconomic environment, if you see a company debt to asset ratio is to the tune of 70% or above, it means two things. This company, it's hard for them to get any more financing in term from debts, and also means this company, in case the economy doesn't do so well, they might have problems financing their liabilities. Okay, yeah. So in a recession environment, these companies don't do so well. Companies with a debt to asset ratio above 60%, they really struggle, and that's something that's going to tell you how well a company is going to do. All right. There are other factors that determine whether the company is going to survive or do well during a recession, and we're going to get to them in a few. But for now, keep this in mind. This debt to asset ratio is very important when you're trying to assess how solvent a company is. Something else you need to remember is that you need to assess the quality of the assets on the company's balance sheet. Like, even before you come to look at the debt to asset ratio, you need to assess the quality of the assets. Remember, there is goodwill, which is usually, especially the intangible assets, that's what I'm talking about. If the intangible assets have been overstated, that's a red flag, and it doesn't matter how good the debt to assets ratio is. There is another ratio called the debt to equity ratio, but this one we're not going to look at it now because we haven't looked at the third part of the balance sheet, which is the shareholders' equity. We'll look at it when we're looking at the shareholders' equity and when you're finalizing on balance sheet, on elements of the balance sheet and the importance. Okay, so that's it for this video for now. I don't think I have anything else to add. I'll, yeah, we'll talk in the next one.